Bill Ackman, one of the greatest investors of the recent times, who has caught multiple good tech trades, has recently announced that he has moved out of Google and now putting his money on Microsoft. The thesis is simple. He believes that Microsoft is a company that is well entrenched in the B2B segment and that contributes around 70% of its profit. He's assuming that Microsoft 365 and the cloud business, which is Azure, will continue to scale well, and that the current market uplift has kind of left Microsoft behind. That means that there is a good scope that Microsoft can come back again and surprise the street and continue to do well. Not one more thing to note is that there's also their economic interest in OpenAI, and they recently just won their battle against Elon, and they will now be going towards an IPO soon. So I believe that there is merit into what Ackman was suggesting, and hence I also decided to dive deeper into the business. As usual, I have also utilized AI into helping what has been going on. So before I go ahead, I feel the financials are telling a good story. Basis their recently reported quarterly results, their cloud computing division is growing healthy at a clip of 28 to 30%, and their productivity suite is also growing at around 13 to 17%. However, their personal computing side is kind of on a, I would say, flattening to declining trend for the moment, given there is a sky high RAM prices as well as low demand over there. Net net, they are still growing at a good rate of 20 to 23% year on year on the net income, which is a healthy clip. Now, what is interesting to see is how can they scale this up further and whether the markets are already placing all of this in. If you look at the results and kind of go deeper into their segments, and this is a report I got made by Claude, what you can see is that cloud revenue is doing really well. Azure as well as Microsoft Cloud is continuing to do stupendously well and has amazing gross margins as well. Right now, you definitely see that going down some bit because there's an AI build and the free cash flow is kind of funding the capex right now. However, the growth is there and it has a multi-year runway as it so seems. Even their co-pilot paid seats has also increased quite massively, and which was just like 15 million in January. So I feel Microsoft has that grip on the enterprise and they are so well entrenched that a lot of companies are scared to sign new contracts with say Claude or Anthropic or even OpenAI. And they trust Microsoft, they already use their services and hence they are willing to kind of onboard Microsoft Copilot as their AI engine, which also reflects that their AI business is now at an ARR of $37 billion, which is growing really fast. However, one thing to note is they also have a lot of capex already announced, which is around 190 billion, which is kind of putting a strain on their cash flows. And you have to note that cash flows are also going to be really important because right now we are in the AI build out phase, but soon we will kind of turn into the AI monetization phase. And that is where I definitely feel Microsoft is well placed and they are also going to do well as time goes on. They have the storm, they have the fortress, they have the capacity, they have the war chest to continue to keep going. And you have to keep in mind that OpenAI also is now going to IPO soon. And that is also going to be like a very big IPO in the range of maybe something like $1 trillion, if that's rumored. But Microsoft also has a good stake there. So expect some really good income bump when that happens. Now, one interesting thing to note is that their consumer division was actually down. And if you were to see, actually, the Xbox sales were struggling. And if I just move over to their highlights in their reports, they basically said across their hardware, across the spectrum, their hardware sales were actually kind of degrowing. And there was some growth in search advertising, which is kind of allowing them to be at par. However, I don't see that this is the thesis of the stock right now. The entire game right now is AI scaling up as well as Azure and their AI division delivering good results, which has been showing promise so far. And I feel that does seem to continue. And that is where actually Bill is also going towards. Now, the other interesting thing is they, however, do not have their own model like Google and Anthropic and OpenAI. And they seem to be playing more on the hardware and the infrastructure side and have their stake in OpenAI, which is how they're playing this growth. So pretty interesting move. I feel they are kind of playing in that picks and shovels technique, which I feel will play well. And the bigger thing is if there is actually a slowdown or like the negative thesis plays out, which is AI growth actually does not happen as expected. I think Microsoft is well placed to kind of weather that through their other divisions and at the same time be able to kind of take the benefit of the growth that is coming in. Now, if I were to talk a little bit more about the valuation side, and for that I have done a reverse DCF, which kind of tells us how much growth the market is currently assuming in the free cash flow to justify the current prices. And if I were to actually just highlight the current prices, Microsoft is at around $423 as of the date of recording and a PE ratio of around 25. The last 6 months to 1 year has actually been kind of brutal in a mega bull market for especially AI based and tech based companies. Microsoft has had their shares of downs. Now, when I talk about this reverse DCF and the valuation, what is really interesting to see is that at a more fading growth model, the expected growth is around 8 to 10%. And if I just put you down to the interpretation, that there is an expectation of around 13 to 16% free cash flow growth over the next decade, and then 3% in perpetuity. So is this reasonable? Currently, Microsoft has been able to do this in the past. The bigger thing to watch out for is how the capex is actually going to play out. If the capacity, if the sorry, the capex intensity kind of normalizes and the build out happens and they actually get to see the benefits as the AI industry is telling us, I think there will be a good time for Microsoft to be able to compound their free cash flows well, since their margins are insane, especially in their cloud division. And if you believe that Microsoft cannot grow that 13%, I think there is a bear case to be made and the stock can be shorted. My personal view is I think that the market is right and actually Microsoft can surprise going forward. And once the build out phase happens, I think Microsoft will start cashing in really well, which is totally the right way to think about it. And I think that is where Bill is also kind of going towards, right? Like all those infrastructure is in place. And the moment, you start kind of have that build out of CapEx kind of being fine, you will soon see the results play in very well. And that is kind of how Bill is looking at Microsoft. And I feel as he's done in the past with Google and also with Meta and maybe Amazon, I think the game is similar. The playbook is very, very clear. You look at the giant that has not grown well or has degrown. And if you see that there is still potential there, as is in the case of Microsoft, I believe, then you can load up the truck. For more, you can check out my Substack as well as my Twitter profile. And I think time will tell whether Bill was right or not. What are your thoughts? Let me know in the comments and I will see you soon. Thank you.